right, welcome to Iron Financial. Today, we are strapping on the hard hats and we're getting straight to work. We are diving into a serious, heavy-lifting explainer session today, and it's designed to help you forge a stronger, much more resilient portfolio in a market that, quite frankly, has been showing some serious structural weakness lately. I'm your lead analyst, and as always, my focus is strictly on the raw numbers. We're talking the revenue, the margins, and the sheer, undeniable load-bearing capacity of the assets you hold in your portfolio.
And I'm the Market Skeptic. I'm here representing you, the everyday investor who is just completely tired of the fluff, the hype, and the corporate spin. My job today is to take a sledgehammer to the drywall, look at the actual framing underneath, and ask the really hard questions. Is the narrative actually holding up, or are there massive cracks in the foundation that nobody wants to talk about? We're looking closely at YUMC China's first quarter 2026 results today, and I'm ready to find out if this thing is actually built to last, or if it's going to completely cave in on your hard-earned capital.
So let's get right down to the core question here. We are looking at a massive, and I mean massive, restaurant empire operating in a highly complex macroeconomic environment right now. Is YUMC China a financial fortress where you can safely park your capital and sleep at night, or is it a crumbling foundation that's just masking a structural failure waiting to happen? Because frankly, when I look at the broader market and I see the consumer data coming out of Asia lately, I see a whole lot of sinkholes forming. It makes me incredibly nervous. And you know what? That is exactly the debate we are settling today. Listen, you cannot let short-term market noise blind you to long-term structural integrity, but at the same time, you absolutely cannot ignore the math when the concrete actually starts to settle. So today, we need to look at the top-line growth, the bottom-line earnings, and the actual tangible cash being returned to shareholders to make a definitive, no-nonsense call on whether this asset belongs in your portfolio right now.
Here is the blueprint for today's explainer. We'll start with the hook, then transition right into the heavy lifting with a revenue drill down and an earnings drill down. Next, we'll check if dividends are reinforcing the structure, take an honest look at market weakness, and finally, deliver the iron financial verdict.
Section 1. The hook, forging your portfolio. Okay, before we can even begin to analyze the stress tests of the first quarter, we really have to understand the sheer scale of the asset we are dealing with. We are talking about forging your portfolio with a company that has a footprint unlike almost anything else in the entire sector. Just look at these operational numbers for a second. YUMC China operates over 18,000 restaurants across roughly 2,500 cities. Let that sink in. 18,000. This isn't just a restaurant chain. This is a corporate behemoth. They have built out an incredibly extensive network of logistics centers nationwide and a massively complex in-house supply chain management system just to support this massive structure.
Look, scale is great, I'll give you that. But scale also means a massive surface area for things to go wrong. When you have an operation this large, structural integrity isn't just a nice-to-have feature. It is a matter of absolute survival. If the framing is weak, a stiff economic breeze can bring the whole entire thing down. 18,000 locations? That means more leases, more overhead, more employees, and a much higher need for absolute operational perfection. A digitalized supply chain is mandatory at that scale. It's not a luxury. So I really need to know what consumer pillars are actually holding up this massive canopy across thousands of cities. What are they actually selling?
Well, the empire is essentially held up by 6 core brands. KFC and Pizza Hut are your primary, heavy-duty load-bearing pillars here. They serve as the absolute, undisputed leaders in the quick service and casual dining spaces in China, respectively. But they aren't just resting the entire building on those 2 beams, they are actively building out a very diversified portfolio to capture all these different consumer segments. They've partnered with Lavazza for a premium coffee concept, they own Little Sheep and Huangjiwang to absolutely dominate traditional Chinese cuisine, and they are expanding Taco Bell for Mexican-inspired fast food. It's a highly engineered mix. Okay, fair enough. So KFC and Pizza Hut are the heavy steel beams, and the rest look like scaffolding for future expansion. It's a diversified mix, which definitely mitigates some of that single-brand risk. But let's be real here. Brand names and future expansion plans do not pay the bills today. Cash flow does. I want to see if this 6-brand structure is actually generating the kind of heavy-lifting revenue required to justify the massive overhead of an 18,000-store footprint. Show me the money.
Section 2. Revenue drill down. Inspecting the beams.
All right, this is where we inspect the actual raw material coming onto the job site, because without it, all construction just grinds to a halt. And the numbers here tell a story of a very, very solid concrete pour. For the first quarter of 2026, YUMC China posted revenues of $3.27 billion. Now compare that to the year-ago revenues of $2.98 billion. We are looking at nearly a $300 million increase in top-line revenue year over year. That is exactly the kind of robust expansion you want anchoring your portfolio. Look, I don't care how many restaurants you have if the sales per square foot are dropping. So I will concede that a jump from $2.98 billion to $3.27 billion is a heavy pour. It's real money. It shows that consumers are still actually walking through the doors despite some pretty heavy macroeconomic headwinds. But, and this is a big but, top-line growth is only half the battle. Was this growth driven by increased foot traffic and real pricing power at their existing stores, or is it just the brute force of opening hundreds of new locations? Did they have to over-engineer their promotional spending and basically give the food away just to hit that $3.27 billion mark?
Well, to answer your question, they didn't just brute force their way to growth, they actually beat the street. The Q1 2026 revenue surpassed the Zacks consensus estimate by 0.73%. And here is the absolutely crucial metric for structural durability that institutional investors look for. The company has topped consensus revenue estimates 4 times over the last 4 quarters. 4 for 4. This means management's forward guidance isn't just some aspirational pipe dream, it is bankable. They have a highly reliable forecasting and execution model that delivers exactly what it promises, time and time again.
All right, beating estimates by almost 0.75% on a multi-billion-dollar scale is real money. I can't deny that. And doing it 4 consecutive times is undeniably impressive. It shows they have a really firm grip on their blueprints. However, anyone can drive top-line revenue if they aggressively slash their margins. We really need to drill deeper to see what's actually making it into the bank vault.
Section 3. Earnings Drill Down. Bottom Line Sanity.
Like the old saying goes, top-line revenue is vanity. Bottom-line earnings are sanity. I demand we look beneath the revenue to see if the actual earnings carry enough weight to support this massive structure. Are they actually turning a real profit on that $3.27 billion, or are the logistical costs of running an 18,000 location empire just eating them alive behind the scenes?
The bottom line is indeed where the true strength of any business model is tested, so let's look at it. Look at the earnings per share, adjusted for non-recurring items. Yum China came out with quarterly earnings of 87 cents per share. Compare that to the 77 cents per share they delivered exactly a year ago. That's a very clean, undeniable 10-cent jump in profitability year over year. They are bringing more money to the bottom line, proving, beyond a shadow of a doubt, that they are efficiently converting that raw revenue into actual, tangible shareholder value.
Hold on a second. A 10-cent jump year over year is solid growth on paper, absolutely. But the market is a forward-looking pricing mechanism. It doesn't just care about what you did last year, it cares about what you did compared to what everyone expected you to do right now. And here is where I see a major stress fracture. That 87 cents per share, it actually represents a negative earnings surprise of 0.29%. So while they technically met the baseline estimate, they missed the whisper numbers, the actual, slightly higher expectations that were already priced into the market by traders. That negative surprise means the company failed to deliver on peak optimism. To me, that is a very real crack in the armor. Let's keep this in perspective, please. A negative 0.29% surprise is essentially an inline quarter. They delivered exactly the 87 cents the official consensus asked for. And you have to remember the context. When you factor in the massive deflationary pressures and the highly cautious consumer sentiment currently blanketing the Chinese macro environment, delivering exactly on target isn't a crack, it is a sign of extreme structural resilience. 0.33% is barely a rounding error.
It's not about the size of the miss, it is about the trajectory. Look at how the momentum is suddenly stalling out. Just a quarter ago, they were expected to post earnings of 35 cents per share, and they absolutely blew the doors off the place by producing 40 cents, delivering a massive positive surprise of 14.29%. Now we've gone from a 14% rocket ship to a slight miss. As an investor, you have to look at this stalling engine. Over the last 4 quarters, they've only surpassed consensus EPS estimates 2 times. That is a 50% batting average. I have to ask you directly, are you really willing to pay a premium multiple for a literal coin toss on earnings?
Okay, that is a fair and honestly very tough challenge. The transition from a massive beat to a neutral showing definitely requires scrutiny. I'm not ignoring that. But you have to remember that management has tools at their disposal to shore up investor confidence and reward shareholders even when that hypergrowth momentum cools off a bit.
Section 4. Dividends. Reinforcing structure.
Here's the thing. When you have an empire generating billions in revenue and clear bottom-line profitability, you have the option to distribute that wealth. According to a direct disclosure submitted in compliance with the Hong Kong Stock Exchange rules, the board of directors will consider the declaration and payment of a quarterly dividend. This resolution was slated to be adopted around April 29, 2026. A consistent, reliable cash return to shareholders provides a tangible yield. It effectively acts as the rebar that reinforces the stock's foundation while you wait for the next major growth cycle to kick in.
Market Skeptic. Dividends are great. I love getting paid to wait. But they can also be a massive distraction. Sometimes a company will use a shiny new dividend payout to patch over perceived cracks in their underlying growth. I want to know if this is a genuine shareholder reward based on massive free cash flow, or just a psychological tool to stop investors from jumping ship due to that stalling earnings momentum we just talked about. Furthermore, the disclosure explicitly states there is no assurance the dividend will actually be declared. We cannot price in the rebar until the concrete is actually poured. And honestly, we cannot let the hype of a potential dividend obscure the grim reality of the tape.
Market Skeptic, Section 5, Market Weakness, Cracks Showing. The foundation might look somewhat okay in a vacuum, but a building is only as strong as the ground it's built on. We need to look at the immediate price action. Here's exactly why capital isn't flowing into this name. Look at the stark reality of the tape. Yum China shares have lost about 0.8% since the beginning of the year. Meanwhile, the broader S&P 500 has gained 4.3% over that exact same time frame. We really need to talk about opportunity cost here. Every single dollar parked in a sinking foundation is a dollar missing out on the broader market rally. Why should an investor settle for a negative return when the broader market is easily generating over 4%? You are losing alpha every single day you hold this. Lead Analyst. The underperformance on the chart is undeniable, I'll give you that. When a company posts over $3 billion in quarterly revenue and still lags the S&P 500 by over 5 full percentage points, it tells you the market is pricing in severe systemic risks. Investors are clearly mindful that the macroeconomic outlook for the region and the specific industry can have a material impact on the stock's performance, completely regardless of the individual company's operational excellence.
Exactly. It's not just Yum China, it is the entire neighborhood they are building in. The Zacks industry ranking puts retail restaurants currently in the bottom 25% of the 250-plus Zacks industries. Think about that. The sector itself is fundamentally weak right now, and historical research is crystal clear on this point. The top half of Zacks-ranked industries outperform the bottom half by a factor of more than 2 to 1. You are literally fighting gravity by investing your capital in the bottom quartile of the market. It's an uphill battle. That is a crucial piece of architectural context for our viewers. Even the most perfectly constructed steel-reinforced building will shudder during a macroeconomic earthquake. If the restaurant sector is broadly out of favor, Yum China is absolutely going to face intense headwinds. But rather than just looking at current sentiment and getting bogged down in the negativity, let's pivot and smoothly examine the forward-looking blueprints to see if the structure can outlast the storm.
Let's break down the consensus estimates to gauge their future load-bearing capacity. For the coming quarter, the Street expects an EPS of 71 cents. They expect this on $3.03 billion in revenue. Now zoom out to the full current fiscal year. Analysts are projecting an EPS of $2.91. And look at this revenue figure right here, a massive $12.71 billion. Let that magnitude really sink in. In a weakening retail environment, generating nearly $13 billion is absolutely monumental.
Those are huge absolute numbers, yes, I agree. But notice that the coming quarter's EPS estimate of 71 cents is a very significant step down from the 87 cents they just posted. The market expects a contraction in profitability in the near term. The estimate revisions trend heading into this earnings release was incredibly mixed. Analysts are looking at the severe consumer spending headwinds in China, and they simply cannot agree on whether to upgrade or downgrade the blueprints. That mixed sentiment breeds uncertainty, and as we all know, uncertainty breeds extreme volatility.
Which brings us to the ultimate synthesis of all these metrics. Yum China currently holds a Zacks rank of 3. Now, in the Iron Financial Framework, a 3 translates directly to a hold. It indicates that, based on the mixed estimate revisions and the current severe sector weakness we just discussed, the stock is expected to perform generally in line with the market in the near future. It is not a screaming buy, but the $13 billion in projected revenue proves it isn't a structural failure demanding an immediate sell-off either. Market Skeptic. Let's be totally real here. A hold is basically market purgatory. It means the stock is essentially treading water. You aren't getting the hypergrowth of a tech stock, and you are currently eating a negative year-to-date return while waiting and hoping for the entire restaurant sector to rotate back into favor. The frustration here is that the foundation is stable, sure, but the building just isn't getting any taller right now.
Section 6. The verdict. Opportunity or trap?
All right, it's time to deliver the final Iron Financial verdict. We have rigorously inspected the foundation from top to bottom. If you are a long-term investor looking for a massive, cash-generating behemoth, the bull case is undeniably strong. We've seen the impressive top-line revenue growth to $3.27 billion and the very clean bottom-line EPS jump to 87 cents. The sheer scale of an 18,000 restaurant footprint, combined with a reliable history of beating consensus estimates and a potential impending dividend acting as rebar, proves this is a formidable operational fortress. Market Skeptic. But we've also shined a very bright spotlight on the undeniable cracks. If you're an active manager looking for immediate alpha, the bear case suggests this might be a very heavy trap. The earnings momentum is stalling with a negative 0.29% surprise. The stock is severely lagging behind the S&P 500, actively bleeding opportunity costs from your portfolio, and the entire restaurant sector is fighting gravity, languishing in the bottom 25% of industries. You have to weigh the raw earnings power against this undeniable market weakness. So ask yourself, in a market full of towering, high-growth high-rises, do you really want your capital tied up in a building that is currently just treading water? The blueprints are in your hands. Forge your portfolio wisely.
Quick disclaimer, everything I share is for entertainment and informational purposes only. I'm not a financial advisor, so please do your own research or talk to a professional before making any moves with your money.